it's a net positive in that the generation of AI becomes a lot easier. It becomes a lot more accessible. And so it's not that AI is no longer viable. It's not, the story of AI is dead. It's the story of AI is more accessible to more companies and to more people.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again, back on the podcast. Favorite time of our week and favorite time of our listeners and our viewers' week.
Well said, Andrew. I can't top that one. Let's get straight into it. What are we talking to everybody about today?
Yeah, so today, first market wrap of 2025. So looking at what's happened over the course of the last month or so, or pretty much exactly, it's been a month. So we're recording this on the 31st of January. I think by the time it goes out, it'll be just into February, but kicking the market wraps off for the year.
Yeah, and let's call it out. Like, there's been a lot happening in the first month of the calendar year. Obviously, we've got a new president in the United States, so we'll talk a little bit about that. But you can't go past the performance of the S&P 500 that's up 2.24% for the month of January.
Yeah, which is, that's a very significant number. And we'll talk a little bit about Nvidia and AI and the impact that that's had. But there's been factors that have driven the US market down in the last week or so. And so the fact that it's still up 2.24% is, it's very, very positive.
And coming off a extremely strong and record year the previous year, right? So
yeah, kicked off with a bang.
Yep. So we put it down to Trump because that's who we're going to talk about next.
Yeah, well, that is who we're going to talk about next. Look, a part of it has to do with Trump. You can't deny that fact, and it's the market anticipating Trump, I think, is ultimately what it is, because since Trump came into office, it's not like there's been any real significant movement in the market. He did sign 26 executive orders on day one, which I think is a record. I know is the record for more than any other president has ever done, but it hasn't had a hugely significant impact on markets, because mainly all of the things and all of the executive orders that he signed, the market already anticipated. He already said that he was going to do long before he came into presidency. And so preempting that, it has already taken a move upwards as a result.
So is it fair to say that the idea of Trump is better than actual Trump itself?
Maybe not just the specifics to Trump. The idea of everything is better than the actual impact of it once it all happens.
But in terms of where the US market is, and considering everything that's going on there, obviously change in political leadership, obviously some really big moves in terms of executive orders, some fairly polarizing opinions about what they're doing with immigration and things that are supported by the majority of the citizens of the US. We're still seeing markets just continue to grow and rally and push through, which is great, because the US leads the way in terms of the economic world, and if the US is healthy, everybody benefits from that, which is fantastic.
Yeah, look, in December we did see US markets pull back a little bit, not over the course of the entire month, but towards the end of the month, just because of some concerns around inflation and the fact that, all of the policies that Trump is enacting and starting to push through is inflationary in nature. And so you did see the market sort of slow down a little bit and then take a bit more of an uptick. So it's interesting that the general consensus of the market is, hey, it's going to be positive even if inflation ticks back up, even if interest rates don't drop as much as what was originally anticipated. It's been responded to in a positive manner.
Yep. Speaking of positive, maybe we'll flip the switch and go the other way and talk about something negative. But in terms
I think it's a net positive. It's a negative for investment markets, but the fact that you can do AI at a cheaper and still effective scale is a net positive.
We'll wait and see. Let's unpack it a little bit. There's probably a little bit in there, but we're talking about Nvidia essentially. So for those who may not know, Nvidia has been this unbelievably successful chip maker recently. They haven't just come out of nowhere. They've been around for ages, but essentially they developed a technology with their chips, and they're basically in the position where they're making the best microchips in the world that are then supporting and are needed in order for businesses to push into AI, because they need obviously powerful microchips in order to do all of the computations and things like that as well too. So Nvidia have been going on an absolute tear in terms of their share price, because the sales that they've been producing have been phenomenal, and each and every month they're breaking records. With that, then last week we saw a company coming out of the US called DeepSeek. A company coming out of China to rival Nvidia, which is in the US, that have basically put out their AI program similar to ChatGPT. This company was founded only a couple of years ago, and the amount of money that they spent in order to get it off the ground is literally in the millions, whereas ChatGPT is spending billions and billions of dollars on infrastructure development, you name it. So what this has done is it's shook markets and basically said, okay, well, maybe that the AI story that we were hearing, where companies take, Meta for an example, they need to buy these expensive chips, they need to build these data centers, they need to pay, they need to start thinking about electricity and how they're going to fuel the need for this AI boom. And then all of a sudden, from an investor perspective, you think this is great. It's going to cause all of these things from an opportunity perspective, more data centers, more electricity, more chips, just a growing ecosystem essentially. And then DeepSeek comes in and basically says, look, we've done this for a few $1 million pales in comparison. And all of a sudden, Nvidia broke a record in the wrong way. They lost 938 billion. Now that's Australian dollars. Yeah. $938 billion in market capitalization in one day.
Broke a record. No company has ever lost that much in market cap in one single day. I mean, granted, they're coming off the back of being the largest company ever in existence. And so that also plays into the fact, but a $938 billion loss has never, that's never happened before.
To give you an idea, to put this into context, approximately it's about half of Australia's GDP in one day, gone.
That's I saw you just doing the numbers there, and I was like, what are you doing here? You're just searching Australia's GDP.
Don't give away my secrets, Andrew.
Look, we're so good that we're also doing information on the fly. We're not only pre-prepared. That's that puts it into a pretty obscene amount of money in one specific day.
What I will say though is there's a fair bit of skepticism around in terms of what has happened here, and it wouldn't surprise me if it comes out that this has been basically a copy and paste job and they haven't developed it themselves.
Yeah, look, that's definitely doing the rounds in terms of rumours and in terms of what people are saying. I mean, either way, if you're able to replicate an AI, or you're able to replicate something that's already in existence and it costs less money, it takes less time, and the results that you can produce are relatively similar, it's a net positive in that the generation of AI becomes a lot easier, it becomes a lot more accessible. And so it's not that AI is no longer viable, it's not, the story of AI is dead, it's the story of AI is more accessible to more companies and to more people.
And barriers to entry in terms of cost, it's going to be cheaper, which means that more people can adopt it and more businesses can adopt it faster. So look, let's wait and see how this plays out. If you just think about the technological jump, I'm trying to scratch my head and going, okay, you compare something like, we're back in the day when we've got horse and carriage, and then all of a sudden...
You're showing your age. I was going to say I was going to say flip phone to iPhone, but then
it's not even. No, it's probably
it's not even that.
It's probably landline technology to literally the best phone, the most advanced phone, iPhone 16.
Yeah.
In a couple of years, it doesn't fundamentally. It doesn't sit right because you can't have that big of a jump in progression in such a short period of time. I was going to say horse and cart to a Formula One car essentially in a couple of years.
Yeah. I think focused a fair bit on Nvidia and AI, but it's a massive story that's happening in markets. So
the 938 billion in market cap loss,
half of Australia's
the conversation.
I like that statistic. Jobless claims. I mean, look, there's not too much to talk about in this. It rose above expectation in the US, so it rose to 233,000. I think that expectation was at 230,000. Not a big concern at this stage, just slightly higher than expectation. But over to Europe. Europe is a bit of an interesting one, and looking a little bit bleak in that market.
Yeah, I mean, look, just generally speaking, the Eurozone economy has not been looking well, and it's been like that for quite some period of time. You look at some leaders in the European market as well too, and specifically Germany is one of those companies. From their perspective, if we look at something like their industrial production, so we'll talk about what that looks like. That fell 15%. So that's a fairly significant number. And if you then talk about, say, another big industry, say cars, that has fallen to 1985 levels, and their exports are at 1998 levels. Like those numbers are just absolutely staggering. If you consider how far back you have to push the records in order to look at that, that's 40 years of where their manufacturing is. What they're doing now is what they were doing 40 years ago.
And that's considering that Europe has also been through its own crisis in the financial crisis. So it's breaking those records in terms of production. And Germany is usually the canary in the coal mine for the European market. So things are not looking too good in Europe. And I think that it's also, to some degree, a transition in terms of what is happening in a particular market segment that the European economy relies on. I mean, European economy really relies on production of cars. That is a big part of their economy. And you're starting to see a lot more, specifically electric car manufacturers, but not just electric, being produced in China, and market really lapping that up in terms of, in terms of lower costs to purchase those vehicles. So I think that Europe is definitely not necessarily a market that you'd be investing in if you were wanting to just leave it there and not look at it for a period of time. So a bit of concern around that market.
Yeah, look, and maybe when the timing's right, it might present some opportunity that things start to turn, everything's a little bit cheaper and provide some opportunity. But look, pivoting across to China, so looking at their retail sales, and exports rose, and it's rebounded to 5.4%. So that's a really healthy number. Andrew, from the property side, that's always been a bit of a thorn recently. What are we seeing on the property side in China?
Look, property side or in property, I mean, sales and investment, it still continued to cool. But then on the flip side, manufacturing and infrastructure investments were quite robust. So there's some signs of life that's coming out of the Chinese economy. I think that's the general consensus. Nowhere near their manufacturing levels of, what they were producing pre-COVID, nowhere near those levels from an investment perspective or even a property perspective. But there's some signs of life that's coming out of the Chinese economy.
And let's talk about Australia, because everybody's keen to hear about. And we leave this one to the end, obviously, because we want to leave the best to last. But
it's not because we want viewers to listen to the entire episode.
It's exactly that as well too. But let's talk about the ASX 200. So for the month of January, it's up a whopping 3.14%.
Yeah. It's eclipsed the US market, maybe not in market capitalization, but certainly in percentage, which is very, very positive from the Australian market side. It's consumer confidence. It's slowly itching higher. So I think that there's a lot more resilience in the Australian economy than what was originally thought. I think that there's it's painting a pretty positive picture.
Yeah, I mean, look. In terms of where we're at with, we might pivot into the inflation data. So this came out at the time of recording a couple of days ago. But when the episode gets published, it'll be a week ago. But inflation has fallen to 3.2%. So some of the commentary that's been going around from economic experts and stuff, they had certain numbers and thresholds around what, if the number came out at a certain level, what would that mean for the Reserve Bank in terms of lowering interest rates at their February meeting? Now, 3.2 is well and truly in the range, and they're making a case that interest rates are going to decrease in February. I think that's been pretty well communicated. So when we talk about consumer confidence, I think all of the signs are there that people are hearing this and going, okay, inflation is coming down, which is great. But then at the same time, there's a better and better and better business case that the interest rates are going to come down, which means I'm going to get some relief on my mortgage.
I think it's a combination of a few things. I mean, you're talking about inflation's come down, unemployment rose. So it rose by 0.1% to 4%, but the RBA was expecting it at 4.3%.
Yep.
So you're at a point where inflation's coming down into the target range. Unemployment is still very, very low. So we're still
relatively speaking,
a very low level of unemployment. You then look at the fact that the Australian dollar is also declining, and not reducing interest rates can have an inflationary impact on the economy when the Australian dollar is also declining. And so time of recording, I mean, the market's pricing in a 95% chance of a rate cut in February. That's, I mean, if you take just that metric alone, you look at it and say it's almost certain that rates are coming down in February. Not that I want to say that, because there's still a lot to play out until, 2 weeks until they make that decision. Who knows what will change by then? But at time of recording, it's looking that it's almost certain that rates will come down, which is also impacting, the ASX and a part of the reason why you're seeing some growth coming out of the stock market. As interest rates come down, your risk-free rate of return, or your ability to put money into cash and still make a return out of it, starts to diminish. And as a result, people need to start looking at investing. So the market's really trying to preempt all of that.
Yeah.
And we're doing it all with unemployment staying at a very, very low level. So it's painting a picture of, and I think that to some degree, the market and economists and everyone are trying to push the RBA to some degree. So whether they, stay strong and whether they decide to hold for another month, either way, at this stage, it's looking like rates are going to be coming down, which, could be a positive picture for the property market in Australia as well.
Well, the other thing as well too is if the RBA theoretically cannot be swayed, right? Because they're an independent organisation or an independent body, and they just do their thing. But
why do you say theoretically, Billy?
Well, this is what I was going to say, talking about the Prime Minister, because we are in an election year, and February is only a handful of months away. Around, people are trying to pick the date that they're going to call the election and all that sort of stuff. But geez, I tell you what, if you're the Prime Minister, if you're the Labor Party, geez, it'd be nice for you to turn around and say, hey, we're combating the cost of living crisis. We've done the right thing from an economic management perspective. We've created the environment where the Reserve Bank can reduce the official interest rate position. So maybe the Prime Minister and the Reserve Bank Governor are, having a drink together and having a chat to see if they can do that. But that's all hypothetical, right? I mean, that doesn't happen. So look,
maybe
we'll wait and see what it looks like. I think all of the signs are there for them to do it. If they've got the gumption to do it, I'm not actually sure. I still think, I've mentioned this a couple of times, but I still think, sort of going back to the comments around Philip Lowe around interest rates aren't going to rise till 2024. They can't afford a misstep, because they'll get absolutely hammered and crucified. I guess the challenge is, do you get the timing wrong? And then if you get the timing wrong, what's at stake? Households have been experiencing a little bit of pain for a long period of time. What's another month or two? As opposed to the Reserve Bank goes, oops, we've got the timing wrong and we've moved too early, and it really starts to, stall the progress of the economy that's of the recovery that it's going through. So, yeah, don't know. We'll wait and see. Look, as a mortgage holder, fingers crossed. A lot of our clients have got mortgages and debt as well too. So fingers crossed that they do reduce, but we'll wait and see.
Yeah, exactly. Reduce it by 1.5%, not 0.25.
Good luck convincing them of that, Andrew. Send them a copy of this podcast and see what happens.
Yeah, and look, it's going to be interesting what the banks do as well, because you're going to see RBA drop by 0.25%, and then you're going to see all of the banks take, a month, 2 months, month and a half to actually pass on a portion of that drop. Whereas when it was going in the other direction, it was the next day, bang, you got a letter from your bank saying interest rates have gone up by 0.25.
Surely if they move by 25 basis points, in this environment, banks will have no choice but to pass on the full rate. Like, you're going to get slammed if you don't.
We'll see.
We'll see. Andrew, well said. Thanks for today's podcast.
Thanks, Bills, and thanks to all of our listeners and our viewers. And we look forward to catching you on the next podcast. Got some value out of that one. Like, subscribe. Billy's put his hand up too early and waved goodbye, but that's all right.
Thanks, guys.
See you guys.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.